Background: the evolution of an investor. When I first began managing my money seriously, I suffered a significant loss due to overconfidence and profound misunderstanding of my own gaps in knowledge and weakness towards biases. That painful education led me to reform my approach systematically, create checks and balances, improve my research methodology, and develop a more rigorous valuation framework. The intellectual foundation for this transformation came from studying investors, bred from the school of thinking established by Benjamin Graham and Phil Fisher. Their emphasis on understanding what you own, rather than simply following market momentum, becomes central to my philosophy. One of the biggest concerns during these early money management years was the digitalization of money and what I call the casino chip effect. When you separate the imagery and connection from with physical money, it becomes harder for a human being to gauge the actual value of their actions, track real gains, losses, or scale of the risks. Fearing I might lose the essential connection with the reality of my capital, I deliberately separated a larger portion of my portfolio into index funds and bonds. This decision protected against my mistakes and limits the tuition I'm paying for my market education, or in other words, paying in my losses. In hindsight, this decision proved remarkably fortunate, and the index funds provided spectacular returns over the past 5 years and served as an excellent hedge against my early stupidity as an investor. The Munger model: simple ideas taken seriously. This decision of owning the majority of my funds in an index fund and high-grade bonds might have made a lot of sense back then, but today, realizing that most of my funds are in a black box in this case refers to a system whose internal workings are unknown or discarded, in contrast to a white box where the internal mechanisms are fully transparent and understood, makes me rather uncomfortable. Charlie Munger's wisdom offers two models that have helped me crystallize this discomfort. The first is his admonition to take a simple idea and take it seriously. The simple idea here is to really understand what you own, not subcontracting investing to a black box and expecting things to go well. Yes, even if the S&P 500 has outperformed most managers in their careers, you will still need to understand what it is that you are buying. The current market weight S&P 500 is heavily concentrated, with just 10 names driving the lion's shares of the past decade's returns. This concentration is particularly concerning given elevated valuations, historic high profit margins, and a business cycle where American equities have enjoyed a significant tailwinds. The risk here is that such narrow leadership, coupled with stretching valuation, could lead to a domino effect within the index during any significant market panics. The comparison model is the second model in which Munger's toolkit that helps me think through owning an index fund. In this example, every day you own an index, you own it over something else, meaning you need to constantly have something to evaluate what you would rather own, sort of like a yardstick. When I evaluate an investment opportunity today and compare it to holding an index, I feel far more comfortable investing a substantial portion of my wealth in companies where I understand the business fundamentals, risks and profit drivers, earning power, and transparent valuation than an index whose main argument for being owned is not valuations, but the notion that the past decade returned is believed to continue and that for over a long period of time, the index fund has outperformed most active trading investors. The past year has really made me ponder whether at this time I should own an index fund. When I think deeply about how index and dollar cost averaging have been marketed, the constant putting money into a market capitalized average to smooth returns over time, two red flags emerge. The first is historic precedence. One could argue that the current evidence of constantly putting money into market capitalized average has become as synthesized as the Nifty 50 was in the 1960s and 70s. During that era, the top 50 companies were seen as a one-decision investment, with the phrase, "You can't get fired for buying IBM." These were considered the ultimate blue-chip buy and hold forever stocks. However, in the correction of the 1970s, many of these names suffered dramatically, with some components dropping 91% from their peaks. Although in hindsight, over 25 years, many of these companies as a group still perform well, it's a risk that would be deeply considered. The parallels to today's concentration index investings are striking. We've simply replaced "you can't fire for buying IBM" with "you can't get fired for buying the S&P 500. The second concern addressing a more fundamental question: what happens if the majority of global cash flows becomes indexed? Fund manager Joel Greenbelt provides what I believe is the best answer to this question. He states that if you have a cash and you keep buying a basket without differentiating what's in the basket, sooner or later you will find bargains available when purchasing certain items separately. If the S&P 500 continues the pattern of the last few decades and keeps growing in concentration, this reality will become an increasing advantage for those willing to do the work of stock picking. As more capital flows passively into the most prominent names, regardless of price, there are opportunities for active investors to find mispriced securities. Both overvalued index components and undervalued non-index components should increase. This factor creates an interesting paradox. The more successful indexing becomes a strategy, the more it may undermine its own effectiveness by creating the very market inefficiencies that the skilled active managers can exploit. The pattern of concern: 8 years of warnings. As I've been pondering my index fund position, I've been rereading and discovering more investment letters from fund managers I follow. A striking pattern emerges. Serious concerns about the S&P 500 valuations began appearing around 2017. If you had taken this advice literally in 2017, you would have missed one of the best historic index funds in market history. However, as you examine the underlying reasons, outlier valuation, risk of falling margins, and exhaustion of many tailwinds that propel businesses to grow at extreme rates, the concern appears prescient rather than premature. Many factors that drove unprecedented growth, such as population boom, economic investment and globalization, supply chain efficiency, and so on, are now poised to face growing pressures. The rule of large numbers is making it increasingly difficult for the big names that overpopulate the index to continue growing at unrealistic rates. Among the most excellent investment letters I've encountered over the past 8 years, those from Semper Augustus Investment Group's LLC stand out, particularly their 2021 and 2024 annual dispatches. While I could attempt to recompile the warning signs and valuation statistics surrounding the index, more experienced fund managers have already done a far superior job than I ever could. Therefore, rather than repeating what fund general partner Christopher B. Bloomstein accomplishes with unparalleled rigor in his letters, I prefer to piggyback on his work and refer you directly to his insights. You can easily find his annual letters online. They are known as some of the longest and most meticulous detailed in the industry. This year's iteration, for example, was 166 pages of pure wisdom. His entire body of work is brilliant, but for our purposes, the specific sections that dissect index performance around secular peaks, like the dot-com era, and outliers, the different assumptions simulated returns require for the next decade to achieve excellent returns, absent hyperinflation, of course, requires for the next decade to achieve these returns, is particularly relevant. They begin on pages 64 to 94. I highly suggest this interesting glances at the letters for its extensive information. It's highlighted focus on current valuation margin rates, the underlying assumptions, and the compound reality that it would be exponentially difficult for the S&P 500 to duplicate the last 5 years' returns in the next 5. If you're pressed for time and need to take away only the most important points from the letter, I've highlighted 5 crucial points below. For example, numerous surveys, both retail and professional investors in the late 1999 and early 2000, concluded stocks would compound over the coming decade at an annualized return ranging from 16 to 20%. Below it is a chart of an archived paper by 2 Harvard researchers, Greenwood and Schulfer, who examined 6 surveys of investors' expectations. While a bit busy, Gallup surveyed of investors between 1995 and 2011 revealed 16% expectations of both expected and minimum expected returns for taking of their 99 on poll. That was the peak. The S&P 500 had compounded at a high teens annual rate for the prior 17 years. Of course, their expectations were ahead of the coming reality. The index posted a total return loss over the next 10 years and returned 7.7% over a quarter century. By the market secular lows in 2002, after the index had declined 49% in price, future expectations were for a 6% annual return. Investing in the rear view mirror. The 2 largest returns drivers over the decades were expansion in the PE multiple from 13x to 22.9 and the profit margins from 9.2 to 13.3. These 2 factors contributed with the majority of the returns earned by the index. Dollar sales compounded by 3.4%, dividends added 2.3, and a net reduction in the share count added 0.7 to return. Decade-longs returns only exceeded 15% on 4 occasions. The late 1920s and 1990s are examples. Washout are equally telling. There are precisely 5 yearly intervals when trailing 10-year returns were 0 or negative, when 1937 of 0, 1938 of negative 0.9, and 1939 of negative 0.1, which followed 1929 stock market bubble and the Great Depression when stocks declined 89% peak to trough, and only again in 2008 of negative 1.4 and 2009 negative 1. The global financial crisis which followed the tech bubble 10 years prior, S&P 500 toughed 57 below its 2000 peak 9 years later. That's despite 8 years of economic growth in the interim. The pattern is simple. Historic low 10-year returns tend to follow historically high valuation levels. Multiple simulations exist, but I would share the simple average simulation. For example, if we assume 8% margins and a 15x multiple for the year 2034, you will have the total returns of negative 1.5. I'll end this tribute with my favorite quote from the letter, also a reference to the Magnificent Seven, found on page 77. I had a vivid dream of the number 7, just a giant 7, and when I woke up, it was 7. So I got up and decided to go to the track because I like to play the ponies. And I get a cab, and the cab pulls up and it's the number 7. So I get to the track and I ask about what I owe, and it was 777. I go through the gate 7, and only booth open is the 7th. I look at the board, and the 7th racehorse named Lucky, number 7, and his odds are 77-1. So I put 700 on him, and believe it or not, he comes in 7th. Norm MacDonald. Personal decision, not universal advice. But now I'm crashing out of my market-weighted index funds. Let me be clear, I'm not suggesting that this is a poor choice for everyone. For the average investor who prioritizes simplicity, consistently invests, and is comfortable with the likelihood of lower returns in the coming decade, or even seeks a hedge against hyperinflation, the rising asset prices, index funds can be perfectly suitable. My conviction, however, stems from the readiness to take the full responsibility of my investment outcomes, fueled by an aspiration to outperform the index over the long term significantly. Without hyperinflation, its future performance will fall short of historic averages. This decision also reflects my comfort in investing in a limited scope of companies I have greater understanding of, rather than pushing a portion of my wealth into concentrated index funds built on the assumptions of perpetual rosy world values as if multiples wouldn't contract. Conclusions: knowing what you own. The market may continue to rise higher and higher from these levels. According to the letters I led, these warning signs started as early as 2017 and have only gotten more and more severe. With its extreme valuation, historic concentration, and specular undertones, today's market environment feels like one of these periods when knowing what you own matters more than riding the momentum. I know many will repeat what I say and tell me I can't time the market, but look at the greatest investors echoing my concerns. Buffett, for instance, also exited the markets in 1969 when he couldn't find bargains, as well as in the late 1980s. Funny enough, Berkshire currently has a huge cash cushion in their books. I'm not trying to time the market perfectly. I'm choosing my own things I understand, rather than hoping that unprecedented market concentration and valuation will continue to work in my favor. As Benjamin Graham once wrote, the market is a voting machine based on momentum and multiple expansion. I suspect we may be entering a period when the weighing will matter more. The ripples are getting larger. I prefer to swim in waters that I know well when the big wave comes. I will end this piece with a famous quote of Marty Whitman, a renowned value investor and a founder of the Third Avenue Management. I had a vivid dream last night. I dreamt that I died and went to heaven when I was reunited with all the great investors who came before me. Ben Graham was there, as well as Phil Fisher, Charlie Munger, and Walter Scholes. Even Jesse Livermore had made it. I asked Ben Graham what was the secret to making money in this market environment. He leaned over and whispered in my ear, the same as it's always been, buying $1 worth of assets for 50 cents. Then I woke up. This memo reflects my personal investment decision based on my risk tolerance, time horizon, and understanding of individual businesses. It should not be construed as investment advice for others. Thank you.